mutual funds are mis-selling you the India equity return. So before I start this topic, let me tell you I'm a big believer of equity, and I generally have a majority of my liquid net worth into equities all the time. In the same way, mutual funds and SIP, form of mutual fund, are great products. The problem is not with the product, the problem is in the way it is sold. So if you look at any of the advertisements or anything from any AMCs, whether it is mutual funds, whether it is any other type of fund management, you will notice this one single statement which tells you the long-term return of Indian equities is 16-17%. Over the long run, you can expect to make 15 to 17% is what many of the mutual fund distributors as well as product sellers and everyone around this industry will tell you so. But that is where we need to look at it. What is the return? And how is this return calculated? How is this average return over the last long period of time, which is say from 1980s till now, which is like almost 40 plus years? How does it sum up? And that is where you will realize that the reality is very different from what is being told to you. So let me take you through the history of Sensex, which is the instrument which most of the funds use to describe the last 40 years of return. So now this is the Sensex. This is a percentage basis or a semi-log scale chart of BSE sensitive index, which as per the data available online or on the websites everywhere, you will see starts off from 1979. But what is funny is the fact that this got published the first time only in 1986, 1st January. So the first 6 to 7 years of data is backdated, and it has only been into feature only after 1986. So let us see. It started off with a base. Again, funnily, when you look at the online data, the base is not equivalent to 100. The first data point you have is at 125. Now, between 1979 to 1986, the index went from 100 to 550. Now, in that period, if you look at it, you have a 28% CAGR for this 7-year period, which is backdated, and there is no way to actually corroborate this data or actually say this is extremely clean data. The next part. Then again by 1988, the Sensex went down to 400. Then it was around 1000 odd levels in the 1990s, and it peaked out at 4500. Now, if you go look at this 4500, just from 1988 to 1992, it's an 11x return in 4 years. I am not even taking the initial data which most of the funds use or everyone uses for reference for India, which is from 100. If you look at it from 100, in 13 years from 100 to 4500, it's like 45x return in a period of 13 years. Do you think that is going to ever happen in your say lifetime also for the Sensex? Now this is where the crux of the return calculation comes for the long-term return calculation of India. Interestingly, between 1990 to 1992, the index went from 1000 to 4500. So it's a four and a half times in less than 2 years, thanks to Harshad Mehta. Now, will we get another Harshad Mehta which will take the markets into a manipulation? Very difficult to say so. Now, suppose that the index went to 2000 in the next 1 year. Now, the fact is, the first private mutual fund actually started in 1993. The return for the same mutual fund till date is sub, say 16-18% or in that band itself. Then if you look at it, we again went back to 4500 by 1994, thanks to the liberalization and the reforms. And the market overrun the whole thing on whatever reasons would it be. Because, why do I say it can be said in hindsight the overrun? Because for the next almost 5 years there was absolutely no return on the Sensex. Then again the index was back to 2000 in 1998-1999. So you went from 4500 to 2000, from 1992 to 1999, one of the toughest periods if you were an equity investor. It went to 6150, made a new high in 2000 thanks to Ketan Parekh. Again, back to 2003, you had 9/11 in the whole Y2K boom and the following crisis. After that, the Sensex was back to 3000. So essentially, over a 13-year period, your return is 0 to minus 33%. Now, the worst part during this period is your FD rates were between 10 to 12%. If I am right, you could have got corporate fixed deposits at 15% or higher. Some will say much higher. I'm saying, but the normal, say fixed deposit 1 year was 10 to 12%, and you lost 33%. Now consider this: the mutual fund started in 1993, 1994, and this happens after 10 years. So nobody will tell you that part. Then we go back to 6250, fall back to 4200. The BJP loses elections. There is a global fall. We are still back to where the market was in 1992. So essentially, up till 2004-05, you had a zero return between 4500 in Harshad Mehta to 2004-05. So it's like 13 years of one loss. Next, the best rally we've seen in the recent times is from 3000 to 21,000 in the global boom. And in 2008, it falls off to 8,000 again. Global financial crisis. Next, we go back to 21,000 in 2010. Then in 2014-15, we go back to 30,000. Before COVID, we were at 42,000 in 2020. We dropped back to 26,000. Now look at it. You are in 2007 at 21,000. By 2020, you are just at 26,000. So that's like, again, 13 years, the returns would not be great. So this is what happens. It's not as easy as it seems. And now today, we topped out at 62,000, we are still at 55, 56,000. But the fact is, when you look at the numbers, yes, 1979 to 2022, the returns are 16%. Then somebody will tell you add dividends and will not tell you that the brokerage rates back in the 1980s, the 1990s were 2.5%, plus you would get very dodgy rates. So it was impossible to actually copy the Sensex also in those times. Then the worst part is, in this period, there was a period of time 1979 to 1992 where the index has gone up 45x. It is not going to happen in the next couple of decades for us also. It's not going to be that easy, or rather impossible. And between that period 1979 to 1986 cannot be even trusted also. That's a 28% CAGR in that period. So we've gone up 5x in 6-7 years. So the actual time to actually take the returns should be from the time we started the first private mutual fund, or you say you take it from the Harshad Mehta bottom, right? So if you say the whole, I just neglect the whole move of Harshad Mehta, then also your returns are what? Your returns are 10-11%. Even catching the exact bottom of Harshad Mehta, it would be 11.5 to 12%. The next most beautiful time you could have bought or timed it perfectly was in 2008. The global financial crisis. You bought it at 8,000 Sensex and you are still holding it. And you still just get closer to the 15% CAGR. Now even if you take from the start of Nifty, which is where it became a much more easier markets to actually trade for the whole institutions as well as retail, we became online, etc. The returns are 11%. So the fact is, you had 16% returns if you started in the 1980s and 90s, when your fixed deposit returns was also 10-12%. Then today we are at 10, 11, 12% returns over the last 15, 20, 25 years. So the reality is what? Your return expectations have been inflated by using the data from 1979 to 1992, which will not happen in your lifetime. So this is how the mutual funds missell you the long-term return story, because when you call a 16-18% return target, I've had this discussions with a few mutual fund distributors a few years back. Stop promising that sort of returns, because when you're say fixed income returns are 6 to 8%, how do you make 2x the return? I think the best investor, the largest investor in the world, also does not have a return expectation of 2x the GSEC rate or the AAA security rate. So the fact is, the returns will beat inflation. Ideally, that is what you should expect. The returns going forward can possibly give you better than fixed income returns. That is what you expect. And there will be periods of time where it will not beat it. So if you would have looked at the markets in 2020, it would not beat fixed income returns by a big margin. If you looked at 2008, it would be terrible. It would be terrible in 2003. So there will be long periods of time where the returns would be bad. But eventually, over the long period of time, this is what you expect, that it should beat the fixed income returns by say 3-4 percentage points, beat the inflation. And that is what the targeting should be. So the mutual funds are sold by telling you that you will make 16-18% returns. I don't think that is possible. And that is why we've put this data out, saying so that if you tone down your return expectations, you'll be able to ride the bull market corrections, the bear markets, and actually create wealth over a period of many years. So keep this in mind. Buy equities with a period of long term. Keep your expectations down. Use asset allocation for better returns than what you can see on the screen. But that is the reality. You'll get a little or a lot more than the FDs, a lot more than inflation. The only way you can do it better is use asset allocation rules, use any sort of analysis to time some part of your portfolio, just increasing cash at the right times by 10-20% in the portfolio, increasing equity in the portfolio in oversold times can change the returns. So that is the reality. So mutual funds are expected to give you this sort of returns and not the returns which you've got historically. Thanks a lot.